Hi guys, so this is a video on how I enter stocks. I always post my entries on Twitter, and a lot of times I get questions from a lot of you asking how exactly do I enter the stocks and why, and if I could go through my process. So in this video, I'm going to go through 4 things. One, the 2 setups that I use to enter stocks, that is breakouts and pullbacks. I'm going to talk about the 3 possible scenarios that you're going to face every morning whenever you enter a stock and how to deal with each of them. Then I'll go through what RVol is, which is another very popular question that a lot of you ask. And lastly, I'm going to talk about where I put my stop loss and the 3 cardinal rules for it. So let me start with the 2 entry setups that I most commonly use. That is breakouts and pullback buys. Neither of these were invented by me, and these are very, very popular setups, but for good reason. They actually have a very high win rate. That is a very high probability of working out. So let me show you an example of both of these. And these are stocks that I just took an entry in yesterday. And this is a chart I also posted on Twitter as I was entering it. So a breakout is a super simple setup. All you have to do is find a stock that's gone up 3 to 5 days and it has a lot of volume. So basically it's showing momentum. If it has a positive catalyst, that's even better. And after going up for a few days, it's basically going sideways on low volume and consolidating. Once it starts doing this, you simply draw a line where the stock is facing resistance. And once the stock breaks through that resistance, you enter. That's all there is to it. It's a super simple but very effective setup. Now, a pullback buy, this is a variation of the breakout setup. And personally, I prefer it because it gives you a better risk reward. And I'll talk about that as we go ahead. The setup is similar in the sense that you find a stock that has momentum. Something that's going up 2 to 3 days has pretty high volume. In this case, we can see that the stock almost doubled, more than doubled, from $15 to $37 in just a matter of 2 days. So that's very high momentum. Now, what happened after that is that the stock just pulls back to a moving average, usually the 10 or the 20 moving average. So it goes down slowly, but on really low volume. And then it decides to break out again. You do the same thing here, which is that you find a short-term resistance. In this case, it was the high of this day and the high of this day. And as soon as it took out that level, I went long. And this is another stock that I actually traded yesterday. And this is a chart that I tweeted as I was trading it. Now, once you've identified a stock that is either that's a good candidate for a breakout or a good candidate for a pullback buy, then the next thing you want to do is plan your exact entry, which is how exactly will you enter the day of the breakout and at what level. So every morning when you come into the market, within the first 5 minutes is when most of my entries are decided. And there are 3 possible scenarios that you could be facing. So the first scenario is where the stock gaps up. So take this one, for example, TGTX. This is a stock that I bought the day before, and this was the entry that I posted as I took it. So this is the daily, and this is the 5-minute chart. And on the daily, we can see a gap up, right? Between yesterday's close and today's open, there's a huge gap. So if a stock is doing this and you still want to enter on it, How and when are you exactly going to enter? Well, you're going to enter on the 5-minute opening range high, ORH, opening range high. Now, what exactly is an opening range high? For the first 5 minutes, you look at the 5-minute chart. Here you change your time frame from daily to 5-minute, and you wait for the stock to make a range. This is the 5-minute range. It makes a candle on the 5-minute chart. This is the high of that candle. This is the low of the candle. What I do is enter when it takes out the high of that first 5-minute candle. So it basically breaks out of the 5-minute opening range. So this was my real entry, and I simply put the stop loss here, and I'll go into details about the stop loss when we come to that section at the end. So hopefully this is clear. Whenever you have a gap up in a stock and you're looking to enter it, you're going to enter on the 5-minute opening range high. Okay, now the second possible scenario is that your stock crosses the previous day's high or the pivot line, this resistance, within the first 5 minutes. Now, I don't generally like to enter stocks within the first 5 minutes, and that's because there's usually a lot of volatility and fake outs or fake breakouts in those first 5 minutes. So I like to give the stock 5 minutes to settle down, make a range, and then enter. Also, the first 5 minutes is usually when retail traders are most active. So there can be a buying frenzy and the stock just fades for the rest of the day if institutional traders don't follow through on that buying. So in 99% of cases, I would wait for the first 5 minutes before I enter a stock. But the only times I would make an exception is if we're in a raging bull market or there's a really strong catalyst on that particular stock or the entire market as well. In that case, I might enter after 1 minute, which is at 9:31 instead of 9:35. So sometimes, because of me waiting for the first 5 minutes, what happens is the stock breaks through that line of resistance, which, if you remember in Gato, was this line within that first 5-minute candle. So what do I do in that case? Very simple. I do the same thing that I do for gap ups. I wait for that 5-minute range high to be taken out and then enter the stock. So in this case, this was the first 5-minute candle. And as soon as the high of that candle was taken out, I entered. Okay, so that is the second possible scenario. If that range or the pivot line or the resistance line or the previous day's high, whatever you want to call it, is taken out within the first 5 minutes itself. You do the same thing and you enter on the 5-minute opening range high. Now the third possible scenario, and this is the one I prefer, is that the stock stays below the H1 for the first 5 minutes. H1 is the previous day high, in case I didn't make that clear earlier. So the high 1 day ago. And this is the these are the commands that we use when we're coding on TC2000. So I just like to use the same ones when I'm referring to them. So if the stock is opening within the range of the previous day's candle or gapping down, then how do we enter it? If and when it takes out the pivot line. Okay, so this was the example of BMEA yesterday. This stock, this is the 5-minute chart, right? So this stock opened here. In the first 5 minutes, it was doing nothing. It just opened at this level within the range of the previous day's 5-minute candle. Sorry, but within the range of the previous day's candle. Then all you do is you can put an alert or a buy stop at the pivot line so that if and when throughout the day it does take out that pivot line, you're either going to be alerted of it or you're going to get a fill. So this one is my preferred method because You get to buy at exactly the pivot line, and you get some time to plan your entries and see how the day is progressing without having to pile into the stocks in the first 5 minutes. So these are the 3 possible scenarios in the morning, every day, right at the open. And based on how the stock is opening and based on how it does in the first 5 minutes, I decide which entry tactic to use. Hopefully this was clear. Okay, now I'm going to move on to the next most important criteria that I use to figure out whether or not I want to enter a stock, and that is RVol. So a lot of you, just like the king of crypto, Mr. KOC here, have been asking, what is RVol? And RVol is actually spelled RVol, where the VOL stands for volume. And I'm going to show you what RVol actually looks like and where I get it from. So this is my TC2000. It's the best software, hands down. I recommend it for anyone trading the US market. RVol is simply this indicator here called volume buzz. Now, how do I get this? All you have to do is go click here, add value column, type in buzz, and you'll get the volume buzz. It's as simple as that. It's auto-generated. You don't need to change anything. It's all there. Now, what is this RVol? Now, this is a number that tells you what volume the stock is trading compared to how much it trades on average. So this number can be either green or red or 0. If it's green, it means that the stock is trading more volume today than it trades on average. If it's red, then it's telling you the stock trades less volume today than it trades on average. So let's see the highest and the lowest and see what they're showing us today. So GFAI is showing me a relative volume or volume buzz of 2,200%, 2.2K, right? That actually means the stock is trading 22 times the volume that it would trade in an average day. This is something that we can also see on the charts to really understand it. This white line here is the average volume that it trades in 50 days. The average volume is around 2.6 million. This stock has already traded 16.5 million shares today, and the volume buzz is projecting that by the end of the day, if the same rate continues, the stock is going to trade 22 times the average volume, which is 22 times 2.6 million. Same way for BMEA. Let's take a look at this. This is the average volume that it usually trades, which is around 800,000 shares. And based on the current rate at which the stock is getting volume, the volume buzz is projecting that by the end of the day, the stock is going to trade 50% more volume than it usually trades. So around 1.2 million in total, 800 plus 400,000. It's 1.2 million. On the other hand, let's take a look at something that has red relative volume. So this means the stock is trading very little volume today compared to what it usually trades. Hold on a second. I just need to check an alert that just popped up. Okay, all good. Yep. Back to cert. So if we see this on the volume chart, this is the 50-day average volume. And as we can see, it's already almost 2 p.m. and the stock has traded very little volume. So the volume buzz is telling us that at the end of the day, the stock is likely going to trade just 25% of its usual volume or 75% less than the average volume. Okay, so that is all that RVol is. Now, how do I use RVol? Usually, whenever I enter a stock, I'll always put in the RVol value at the time that I'm buying it in the tweets. And this seems to confuse a lot of people who understandably ask, how can you tell the RVol that early? Do you have an indicator? So how do I tell this RVol that early? It's by using the same volume buzz indicator. What we need to remember is that, say we're buying this stock now at 2 p.m., we don't really know what the final volume for the day is going to be and how many times the average that's going to be, right? So this volume buzz makes a projection that based on the data so far and based on the amount of volume so far, what is the end of day likely going to look like? So this is never going to be 100% accurate, except at the end of the day. And as we progress more and more into the day, the projection will be more and more accurate. So at 9:30 or 10 a.m., it's going to be wild and wildly inaccurate, but it still gives us a sense of direction. Are we trading higher volumes so far than we usually trade up until this time or not? So that is how I figure out what the RVol is likely to be at any given time. Like in this trade, which was taken at, I think, 10 or 11 a.m., it was able to project that the volume at the end of the day would be double the average volume. Okay, so now let's go through a few examples of how I use the RVol. So say this is what my watch list for the day looked like. What is this telling me? Well, what it's telling me is two things. One, most of the stocks in the watch list are down on the day. So if I'm looking to buy a breakout, then the environment is not really good for that, and I should stay away. Two, what it's also telling me, based on the RVol, is that these stocks are going down on heavy volume. Now, volume actually confirms the price. So it tells you whether the price movement is likely to stick or not. So in this case, it's telling me that yes, this price movement is likely to sustain. And since stocks are going down on very heavy volume, I should definitely stay out and not try to buy breakouts right now. So you might find one stock in your watch list that's breaking out, but are you going to be desperate to buy that one? Most likely not, since the environment is not conducive to breakouts. Now, suppose my watch list looked like this in the morning. What is this telling me? Ask yourself. Well, first, it's telling me the market is really good, conducive for breakouts. Most of the stocks on my watch list are green on the day. And second, they all have high volume, which means a lot of serious buying is coming in. This is the kind of environment in which you want to buy breakouts because they're the most likely to actually have follow through. Let's take another example. And this is my real watch list from today that I just took a screenshot of in the morning. So what is this environment telling you? Here, the percentage change is mixed. So a few stocks are up and a few stocks are down. But also look at the percentages. The stocks that are actually up, are they up big? No, not really. It's just a 1%, 1%, less than 1%, and 1.5% move. And more importantly, look at the volume bars. Everything is red except one of them. Now, in this kind of environment, I'm not really convinced that buying is coming into the market, and more importantly, that it's going to have any kind of follow through. So this environment would again make me want to sit out. And that's exactly the reason why I didn't buy GFAI in the morning, even though I saw it breaking out, because it was the only one on my watch list breaking out. Now, of course, it did have follow through. So this is not a foolproof system or not going to work every day. What we're dealing with though is probabilities. And probabilistically, this was very unlikely to have follow through given that the rest of the market was not really going up and there was no volume coming in. Now let's take a last example. Say this is what my watch list looked like. Predominantly red and no high volume movers. What am I going to do in this environment? Again, sit out. This is not telling me that a lot of buying is coming into the market. There's very few stocks going up, and that too by a very small amount. But more importantly, the volumes are not there. If the volumes are not there, the likelihood of follow through is really, really low. So this again would not interest me and make me want to sit out. So hopefully this gives you a good sense of what RVol is, how we can get an indication early in the day and at any point in the day of what the RVol is going to be at the end of the day, and the four different scenarios that you're likely to see every morning of what your watch list would look like and how you can interpret that price and volume change. Whether you should be bullish on the market, bearish on the market, and how aggressively you should be buying breakouts based on what the RVol is telling you. Okay, now there's one more way to use the RVol, and that is to combine it with news. That makes the RVol even more powerful. Sometimes what you're going to see, and this is a live example from today itself, in a stock that I currently hold a position in, and this just happened an hour ago. I suddenly saw the RVol on this stock go up. You can see this on the 5-minute chart as well. Volume came in and suddenly the RVol turned from red to green. So when situations like this happen, what I usually like to do is search if there was any kind of news item that just came out that made the stock pop. So I just went on Twitter and searched for AMPX, and I found this. Amperius Technologies is preparing to supply commercial level shipments to AeroVironment in support of blah, blah, blah. Okay, so this is what it just tells me is this positive news. And as soon as this news came, the stock got a pop. Now, how will I use this combination of news and RVol? Since I was already in this stock from here, and it had popped up to here and started to go up on big volume, which was backed by news, I just moved my stop loss up to break even and made the trade free. So my thinking was that since it's going up on legit news that is positive, preparing to supply, that's all you need to know. Those are the keywords. If the stock is truly bullish, it's not going to take out the low and definitely not going to take out this low, which was my buy point. And I could just move the stop up here and make the trade free. And by the trade becoming free, what I mean is, even if my stop loss is now hit, it's going to exit me at the cost price and I'm not going to lose a single dollar on it. So using the RVol in combination with the news can give you a lot of minute data that can actually help you manage the trade much better. And you can actually do the same thing when you're entering a stock as well. TGTX, for example, when I bought it on day one, when it was gapping up, with gap ups, you usually want to check if there is any kind of news. And if there is, then that's a super positive, and that gives you more additional impetus to get into the stock. So stock going up is good. RVol added to that makes it really good. And then if there's news behind that RVol, that makes it really, really good. That's the bottom line. Okay. Now, the last part of how I enter stocks is putting a stop loss. That is super important. And there are 3 rules that I usually follow for a stop loss. And these are rules that I never break. So, or rather should never break. Sometimes I do, but we're all human. Okay, so the first rule is if you're buying a breakout or a pullback buy, you want to put the stop loss at the low of day. The idea behind it is really simple. If the breakout is real and has to have follow through, it's never going to pull back and take out that low of day, which is now support. So if it does, the breakout has anyways failed and being invalidated, and you wouldn't want to hold that stock anyways. So instead of going through a really complicated process of where should I put my stop loss, what's the stop loss on this, blah blah blah, and asking yourself every single day, just remember the main rule, which is put your stop loss at the low of day, especially if you are trading breakouts and pullbacks. Different setups might have different stop loss rules, but for these 2 setups, the rule is very clear. Put the stop loss at the low of day. Okay, now this is a rule that is not very commonly talked about, but you want to put stop losses at less than 1 ADR to maintain the risk reward. Now, what is ADR? ADR is the amount that a stock generally moves in 1 day. So it's the range of a stock in 1 day. And I'll take you through a few examples. What I want to show you is that stocks with different ADRs need different percentage stops. So let me show you the example of SPY and BMEA. So SPY here, and this is me putting the ADR on the charts. You can do that as well. The formula for this is really easy. I can show it to you here as well in case I forget to add it later to the bottom. Okay, indicators and chart plots and ADR. Yeah. This is the formula. 100 into average high by low of the last 20 days minus 1. That's it. And I always have it added here on my charts so I can quickly refer to it. Now the SPY has an ADR of 1.2. What does that mean? On average, in the last 20 days, the intraday range of the SPY, which is this range, is 1.2%. Now let's compare it to something like GFAI, 34.2%. What does that mean? In the last 20 days, the intraday range of all of these candles, so the last 20 candles, was 34.2%. These, as you can see, can have a very, very wide range. If you're trading a mega cap like Apple, you're going to have a very low ADR of 1.7%. But if you're trading a growth stock like, say, BMEA, which I took yesterday, it can have an ADR of 11.9%. Now, are you going to put the same percentage stop on both of these stocks? To me, that doesn't make any sense. I hear a lot of traders saying, oh, I put a 5% stop. Oh, I never put more than a 5% stop. I always use a 2% stop. I always use a 1% stop. See, none of those statements make any sense to me because each stock has a different character. If I went in with the rule of always using a 1% stop or 2% stop on a stock like BMEA or GFAI, that would make no sense. Look at how much range they trade every day. Even on this day, which actually looks small, the range of this stock was 16%. So using a 1% or 2% stop on this is just immediately going to stop you out in normal intraday volatility, right? And on the other hand, if I'm trading something like Apple and I'm putting a 5% stop, that again makes no sense because that would be too wide for this stock. Now, the other way to think about this is also how many days would it take that stock to make that kind of move? So if Apple is moving 1.7% a day, and I am using a 5% stock, for Apple to even go up 5%, it's going to take 3 days on average. Now, for it to go up twice of how much I risk, it's going to take 6 days on average. So again, that stop loss makes no sense and would be too wide for Apple. So what I always do is look at what any given stock has an ADR of, and then put a stop loss which is less than the ADR of that stock. So if I were trading Apple, I would use a stop that is less than 1.7%. If I were trading BMEA, I would use a stop that is less than 11.9%. If I were trading Gato, I would use a stop less than 7.7%, and so on and so forth, right? Hopefully the logic behind that makes sense and why I don't just use a blanket percentage for all my stop losses, because the stocks in the US market have such variable characters. So that is my second rule of put the stop loss at less than 1 ADR, and that maintains your risk reward. So you're taking a reasonable amount of risk and expecting that if the stock goes up for the next 2 to 3 days, you're going to be profitable and can take partials off. Now, the third and the last rule that I absolutely always follow is that I always put a stop loss of less than 12%, regardless of what the ADR is. So say even if I were trading GFAI, which we just had an ADR of 34%, my stop loss will not be more than 12%, ever. Ideally, you want it to be 10%, but the max room I would give it is 12%. Why is that? Because of this. Losses work geometrically against you. This is just math. If you have a stop loss of 5% and the stock goes down 5%, you're going to need that stock to recover 5% to break even, which is fine, which is doable. If the stop loss is at 10% and the stock goes down 10%, it's going to need to go up 11% to come back to that original point. This is also doable and achievable by a stock. But this is where it starts to get really problematic at more than 10%. If a stop loss is at 20% and the stock actually goes down 20%, it's going to need to go back up 25% just in order to break even. And if you put it at 30%, it's got to go up 43% and so on and so forth. So losses are working geometrically against you. Take a simple example, say a stock is $100 bucks. You put the stop loss at 80 bucks, and that gives you a stop loss of 20%, right? The stock now comes down, comes to $80, almost about a stop you want, but then turns around. Now, if the stock needs to just get back up to 100, it's got to go up 25% from that $80 just to get up to 100. This is why 10% or max 12% is my limit. That's a cutoff. This is a hard rule. I have coded this into my Excel. So if I ever have a stop loss of more than 12%, my Excel is going to show me an error and I would not even be able to take that trade. You never, ever, ever want to break this rule. It's just going to make it that much harder for you to recover the money. Okay. Now the only nuance I would add here is if you're trading EPs and SIPs, then if you're buying them after the open, you're going to use the low of day after the 5 minutes. That is the same rule as what we do for any other trade, a breakout or a pullback trade. But if you're buying the EP in the free market, then where would you set your stop loss? That is a question that I asked myself for years and years, and I finally came up with a solution, with a rule for myself that makes sense to me. I just put the stop loss at the pre-market support level. So let me give you an example. GFAI was a pre-market mover today. It had some relative volume coming in, and I was tempted to buy it in the morning, but unfortunately I didn't. But say I had bought it here. This is the pre-market. You can see this from 4 a.m. to 9:30 a.m. The low of this pre-market is where I would put the stop. So basically treating the pre-market as a regular trading day, and just like you would put the stop at the low of day, you're putting it at the low of the pre-market. To me, that makes sense logically. If it doesn't to you, you can come up with your own rules that make sense. And hopefully this video on entries has been useful. The 2 setups that I used, the 3 scenarios that you're likely to encounter in the morning, what RVol is and where I put my stops. If there's anything that I missed about my entries, I'm more than happy to follow up on this. If you found this video helpful, just let me know, because that encourages me to keep going. I am not a professional YouTuber, but a professional trader. And I just started making these because it seemed to be helping a lot of people. So let me know what you think, and I'm happy to answer any questions you have. Thank you.